Picture this, it is the middle of July. The heat is just bouncing off of the pavement, but you honestly don't even care because you just landed your first real summer job.
Oh, that is the best feeling.
Right. You're making $15 an hour, which, when you have never had a steady income before, it feels pretty fantastic. So you work exactly 20 hours your first week.
A solid week.
Yeah, and you do the mental math on your walk home. 15 times 20. That is a clean, beautiful $300. You are already mentally spending it. A new pair of shoes, gas for the car, maybe funding your entire weekend plans.
But then Friday morning hits.
Exactly. You wake up early. You don't even get out of bed before you grab your phone and open your banking app. You are fully expecting to see $300 sitting right there. But the deposit is only $253.05.
Universal gut punch.
It really is. You literally stare at the screen. You close the app and reopen it thinking maybe it's a glitch. Still $253.05. The immediate sense of betrayal sets in, who took your money? Where did nearly 16% of your hard-earned cash disappear to overnight?
Yeah, it's brutal.
This is TeensCore Podcast, where we help you stop being broke, build smart money habits, and take control of your financial future early.
Millions of young people experience that exact visceral feeling of betrayal every single summer. It is arguably the ultimate American rite of passage at this point.
Absolutely.
Just looking at the labor data from the sources we pulled for this deep dive, there were over 6.3 million American teens in the labor force in 2023.
Wow. That is a ton of kids working.
It's a massive wave of newly minted workers, and they're all walking into the exact same wall of what we call paycheck shock, all at the exact same time. Entering the labor force is this monumental developmental milestone, right? It's your first step into true autonomy.
But no one actually warns you about the math.
Exactly. Our educational system has completely dropped the ball here. The surveys we looked at are actually quite staggering. They consistently show that over 20% of high school students lack even the most foundational basic financial literacy. We are sending millions of teenagers into the workforce completely blind.
Yeah, and that lack of financial literacy isn't just, some abstract failure on a multiple choice test. It has immediate tangible consequences. It literally costs you money out of your own pocket.
Real dollars.
So our entire mission for this deep dive into the source material is to completely decode the American tax system, specifically for teenagers and young adults. Because the harsh reality is, if you do not understand these rules, you're either leaving free money on the table by not claiming refunds.
Which happens a lot, yeah.
Right. Or you are walking blindfolded into a massive trap of IRS penalties. And that danger is exponentially higher today with side hustles and gig work.
Oh, absolutely. The modern digital economy is unforgiving in that regard. It demands that you become a financial adult the very second you monetize a hobby or download a payment app.
So true.
To really unpack this, we need to solve the mystery of you're missing $46.95 from that paycheck scenario. We have to look at the literal anatomy of a paycheck.
Right, the breakdown.
Yeah, so the core concept here is the divergence between gross pay and net pay. Your gross pay was that theoretical $300. It's the number you were promised. But your net pay, the actual tangible take-home amount, is the $253.
And the void between those two numbers is entirely made up of withholding.
Exactly.
When you look at an actual pay stub, the biggest chunk of money missing usually has 4 very specific letters next to it. FICA, F-I-C-A. And for a first-time worker, FICA just feels like a very expensive country club that you never signed up for, but they are auto-drafting your account anyway.
That's a great way to put it. So FICA stands for the Federal Insurance Contributions Act. The most important thing to understand about FICA is that it is entirely, unequivocally non-negotiable.
So no getting out of it?
None. There is no legal maneuvering. It is a flat, statutory 7.65% tax on your earned income. The government essentially slices it into 2 distinct parts for 2 different federal trust funds.
Which are what exactly?
6.2% of your paycheck goes directly to Social Security, and the remaining 1.45% goes to Medicare.
Wait, so my mandatory contribution is for the national safety net for the elderly and disabled. I'm 16 years old working the fry cooker, and a portion of my labor is immediately diverted to pay for my grandparents' retirement.
That is the literal mechanism of the system, yeah.
Yeah.
The money isn't put into a personal lockbox with your name on it for when you turn 65. Taxes being collected from young workers today are actively being used to pay the benefits of current retirees.
Wow, okay.
And there's a critical misunderstanding that traps a lot of first-time workers here. FICA taxes are completely non-refundable.
Wait, really? None of it.
None of it. Let's say you only worked for 3 weeks out of the entire year. You made a grand total of $500, and therefore you owe absolutely zero federal income tax. You might think you get all your withheld money back, right?
Yeah, that's what everyone assumes.
But you don't. That 7.65% that went to FICA is gone forever. It is your permanent, required contribution.
Okay, well, that accounts for roughly $23 of my missing money. But I am missing almost $47 total, so there are definitely other hands in my pocket.
There are. The remainder of that missing money consists of variable income taxes. This is where your withholding splits off to fund entirely different levels of government. Depending on where you live, you are dealing with federal income tax, state income tax, and potentially even local or city taxes.
And those go to completely different things, right?
Exactly. State and local taxes are heavily focused on funding the immediate physical world around you. When you drive to work, state taxes paved that road. They pay the teachers at your public high school, they fund the municipal parks, the local fire department, all of that.
Meanwhile, the federal withholding is getting sent off to Washington, D.C. to handle, like, the macroeconomic scale of the country.
Correct.
Yeah.
Federal income tax funds the national apparatus. We're talking national defense, massive infrastructure projects like the interstate highway system, and broad safety net programs like SNAP benefits or Medicaid.
You know, let's pull back from the math for a second and look at the underlying philosophy of this. Because if you sit down and try to explain this to a teenager, it honestly just feels like legalized theft. They work the hours, but someone else is taking a cut by force.
It definitely feels that way.
But the source material touches on this fundamental concept called contributivism.
Right. Contributivism is essentially the ethical foundation of the entire tax code. It is the social contract in action. The philosophy argues that because you reside within a functioning society and actively consume its public goods, you are morally and legally obligated to contribute to maintaining them.
So because I use this stuff, I have to pay for this stuff.
Basically, yeah. You didn't build the public roads, but you ride the bus on them. You benefit from the stability provided by the military. Therefore, you must pay into the collective system.
I understand the underlying logic. It's basically a mandatory subscription fee for living in America. You use the platform, you have to pay the monthly fee to keep the servers running.
That's a very modern way to look at it.
But here's where I am going to push back incredibly hard. And I know for a fact a lot of teenagers listening to this deep dive are going to agree. I am a minor. I cannot legally vote. I cannot choose the mayor who decides the local tax rate. I can't choose the president who writes the federal tax code. How is it remotely fair under this social contract that I am forced to pay the subscription fee when I have absolutely zero say in how the platform is run?
You know, connecting this to the broader historical picture is vital, because that is not just a teenage grievance. It is perhaps the most fundamental political argument in modern democratic history. Validating that exact frustration is critical here.
Because it's a huge deal.
The complaint you just articulated, the fury of being taxed by a government while being denied a voice within that government, literally started a war. It is the direct historical root of the entire American taxation system.
No taxation without representation. It's like the bumper sticker slogan we all memorize in middle school history class. But when you are 16 and looking at your first pay stub, it suddenly becomes incredibly personal.
It really does. And the history of that phrase goes back much further than the American Revolution. The legal precedent actually starts in medieval English law. If we trace the lineage back to the Magna Carta in the year 1215, specifically Chapter 12, it established the principle that the king could not simply levy taxes without obtaining the common council of the kingdom.
Meaning the king couldn't just arbitrarily empty the pockets of the peasants to fund a foreign war whenever he felt like it.
Right, without at least consulting the barons and getting some form of consent. And this tension erupted violently during the English Civil War. There was a prominent parliamentarian named John Hampden in the 1630s. King Charles I tried to levy a tax known as ship money.
Ship money?
Yeah. Historically, it was only collected from coastal towns during times of war to fund the Navy. But Charles tried to levy it during peacetime across the entire inland country without the approval of Parliament.
I bet that went over well.
Not at all. John Hampden famously refused to pay it. He was put on trial, and even though he technically lost, he became a massive public hero. His defiance cemented the cultural belief that a government simply cannot extract wealth unless the populace is formally represented.
So you fast forward 130 years to the 1760s, and the American colonists are feeling exactly like the teenager holding that short paycheck today. They're looking at the British Crown and saying, "You are depriving us of our rights."
Exactly. The English Bill of Rights of 1689 made it explicitly illegal for the Crown to impose taxes without Parliament's consent. But the American colonists had a major logistical problem. They had 0 representatives sitting in Parliament in London.
So they were completely shut out of the room.
Entirely. So when the British government started passing legislation like the Stamp Act of 1765, which taxed basically every piece of printed paper in the colonists were outraged. It wasn't just about the money, it was about the principle of consent.
And then that's where James Otis Jr. comes in, right?
Yes, a local Boston politician. He crystallized this anger in a 1764 pamphlet, making the famous declaration that taxation without representation is tyranny.
But the British government couldn't have just ignored that argument. I read in our sources that they tried to claim the colonists actually were represented, which just sounds like incredible political gaslighting.
It was a highly controversial theory called virtual representation. The British Prime Minister, George Grenville, argued that the colonists did not need to actually cast a ballot. They claimed that the members of Parliament virtually represented the interests of all British subjects across the entire empire.
Wait, really? The argument was essentially, we know what is best for you, so by default, we represent you.
That was the literal argument, yes.
That is the most incredibly convenient, self-serving argument imaginable.
Yeah.
It is like a group of older friends ordering a massive pizza, charging you for your slice, but absolutely refusing to let you pick any of the toppings because they virtually know what you like.
And you end up with anchovies.
Exactly. Of course you end up with a pizza you hate.
The colonists felt the exact same way. It was insulting, and prominent British politicians openly agreed with them. William Pitt the Elder, a highly respected former prime minister, gave a blistering speech where he ridiculed the theory. He called virtual representation the most contemptible idea that ever entered into the head of a man.
Wow, that is strong wording. But the narrative through line here is what makes this so fascinating. If we extrapolate this entire historical saga to the modern day, the American teenager is essentially the modern-day colonist.
Based on the structural realities outlined in our sources, it is a highly accurate parallel. Today, working teenagers under 18 are paying billions of dollars into a tax system without possessing the legal right to vote. They are taxed without direct representation.
And it's not just teens, right?
No, residents of Washington, D.C., Puerto Rico, and immigrant permanent residents are all subject to federal taxation while being denied full federal voting rights.
There are advocacy groups actively fighting this dynamic right now, though, like the National Youth Rights Association or NYRA. They are heavily focused on this exact contradiction.
Yeah, the NYRA advocates aggressively for lowering the voting age. Their foundational argument relies directly on that James Otis Jr. philosophy. They argue that if a 16-year-old is legally permitted to enter the labor force and is required to pay income taxes, they should be enfranchised to vote.
But the immediate counter-argument that gets thrown back at them is always about maturity, right? Like, a 16-year-old isn't educated enough about complex civics to responsibly cast a ballot.
That's the standard rebuttal, yes.
But the NYRA points out a pretty brutal statistic regarding adults. Only 47% of American adults can actually name all 3 branches of government.
It's a sobering number.
Seriously.
Yeah.
When less than half of the voting age population understands the basic framework of the Constitution, the whole civic education argument used against teenagers starts looking incredibly fragile.
And we should note, the debate over lowering the voting age is highly complex and polarized. We are entirely impartial on this issue. Our goal isn't to endorse lowering the voting age, nor is it to argue for keeping it at 18. We're simply unpacking the viewpoints from the source material.
Of course, we're just reporting the facts of the debate.
Exactly. But exploring this highlights the unyielding tension for young workers. The law requires you to pay your taxes, regardless of your franchise status.
Right. Since we can't vote our way out of the tax bracket yet, we still have to play by the rules. We are stuck paying the subscription fee for now. The real question is, how do we actively protect our paychecks right now at a normal teenage job? Let's transition into W-2 jobs and demystify the W-4 form.
Let's do it. A W-2 job is your standard traditional employment. Working retail at the mall, flipping burgers, lifeguarding. The defining feature is that your employer acts as your tax intermediary.
Meaning they do the math for you.
Right. Their payroll department calculates your liability, withholds the funds, sends them to the IRS, and then issues you a Form W-2 at the end of the year, summarizing everything.
But the catch is, the employer's payroll software isn't psychic. They only know how much to take out because of a specific piece of paper you fill out on your first day, the W-4, and I think almost everyone completely messes this form up. their first time.
Oh, it's notoriously intimidating. It looks like a cryptic legal document. But for a teen working a summer job, navigating it usually comes down to one singular concept: the standard deduction.
Okay, break that down for us.
The standard deduction is essentially a baseline threshold established by the IRS. It's an acknowledgement that a certain amount of income is required just to survive, so they don't tax the first chunk of your earnings. If your total earned income for the year remains below this threshold, you generally do not owe a single penny of federal income tax.
What are the actual numbers for those thresholds right now? Because that is the magic number every teen needs to know.
They adjust slightly for inflation. But for tax year 2025, the standard deduction for a single filer is $15,750. For 2026, it increases to $16,100.
So mathematically, if I'm a teenager working a summer job, and I know for a fact I will earn less than $15,750 this year, I have zero federal income tax liability.
That is the mathematical reality.
So if my liability is mathematically zero, I obviously do not want my employer siphoning federal tax out of my paycheck every Friday. How do I actually communicate that and stop the withholding?
This is where understanding the exempt status becomes incredibly lucrative. When you were filling out your W-4, you look at your situation. If you had zero federal tax liability last year, and you expect to have zero this year because you'll earn under that standard deduction, you can claim exemption.
You literally just write it on the form, right?
Yep. You bypass the complex worksheet, scroll down to line 4C, and literally write the word exempt in the space provided.
Writing exempt on an official IRS document feels like finding a cheat code in a video game. It essentially puts up a deflector shield around your paycheck.
It is a phenomenal tool for cash flow, but we must add a massive caveat here. The exempt status only shields your paycheck from federal income tax withholding. It does absolutely nothing to stop payroll taxes.
Oh, right, FICA.
Exactly. Your employer is still strictly bound by federal law to withhold that mandatory 7.65% for FICA. There is no line on the W-4 that allows you to claim exemption from Social Security and Medicare.
So the shield protects you from income tax, but FICA always pierces the armor. Now, let's look at tip employees. A massive percentage of first jobs are in the service industry. Waiters, baristas. Because tips are often handed to you in cash, there is a widespread assumption that they are off the books.
And that is a dangerous, systemic misconception. In the strict eyes of the IRS, there is no such thing as off-the-books cash. Waiters and delivery drivers are legally mandated to report 100% of their tip income, whether it is cash or credit.
It's taxable earned income, period.
Plain and simple. However, the legislative landscape surrounding tipped workers just underwent a seismic shift thanks to the One Big Beautiful Bill Act, or the OBBBA.
Yeah, the OBBBA has been all over the news. What is the actual mechanism inside that bill that affects the teenager slinging lattes?
The OBBBA includes a provision that drastically alters the reality for service workers. Workers in nearly 70 designated tipped occupations are now permitted to deduct up to $25,000 in tips from their federal taxable income.
Wait, $25,000? That's a staggering change. For a teen server working weekends, that basically means their entire tip income might be completely shielded from federal income tax.
Exactly. But the crucial mechanism to remember is that the deduction happens after reporting. You still must report the tips to your employer and the IRS. The deduction just removes that income from your taxable pool when you file.
And that reporting requirement leads us perfectly into challenging one of the most stubborn myths out there. I hear this logic constantly. I only made $3,000 this summer. That is way below the standard deduction. Therefore, because I don't owe any taxes, I shouldn't bother going through the hassle of filing a tax return.
Following that myth is a guaranteed way to lose your own money. Let's trace the mechanics. Suppose you didn't know about claiming exempt. Your employer's payroll system aggressively withheld, say, $300 in federal income tax over the summer.
Okay, but my total earnings were only $3,000.
Right, which is below the deduction, so your actual federal tax liability is zero. You do not owe the government that $300. It rightfully belongs to you. But the IRS is not an automated customer service department that's just going to mail you a refund check out of the kindness of their hearts.
Yeah, the government isn't going to track you down to hand you cash. You have to formally ask for it back.
That is the entire function of a tax return. You must file a Form 1040 to reconcile your account. Filing the return is you showing them the math. I earned $3,000. I owe zero. You took $300. Give it back.
And if you don't file?
If you simply choose not to file, the IRS will happily keep your money.
Oh.
You are effectively giving the federal government a permanent voluntary donation.
Which brings up a really common behavioral strategy I've noticed. I've had friends who completely understand the W-4, but they intentionally choose not to claim exempt. Their logic is, look, I am terrible at saving money. If I have it, I'll spend it on iced coffee. So shouldn't I just let the IRS take the maximum amount out of my check so that I get a massive forced refund check in the spring?
The forced piggy bank strategy.
Yeah, exactly. It operates like a forced piggy bank.
That's incredibly common, even among adults. But we need to critically examine the economics of this approach. The primary pro is entirely behavioral. If you lack discipline, the IRS acts as an automated barrier. You don't see the money, so you can't spend it, and then you get a windfall in the spring.
But what is the mathematical cost of outsourcing your discipline to the federal government?
The con is rooted in the time value of money. When you overwithhold your taxes, you are literally giving the federal government an interest-free loan for months on end. The government is holding your money, and they are not paying you a single cent for the privilege.
And with inflation, the purchasing power of that money is actively degrading while they hold it.
Exactly. A dollar withheld in January was worth slightly less when it is refunded to you the following April.
So how do you take control of that? What's the alternative?
Understanding opportunity cost. If you claimed exempt, took that exact amount of money that would have been withheld, and automated a transfer into a high-yield savings account every Friday, the dynamic flips. Now you are earning interest on your own capital. Relying on a tax refund is ultimately a penalty on your own wealth creation.
Seizing control of your cash flow is a great philosophy when you actually have a boss handing you a structured W-2. But the economic reality for young people has shifted dramatically. What happens when you are your own boss?
That changes everything.
Right. What if you were generating income directly from your phone or hustling around your neighborhood? Because for Gen Z, cobbling together multiple streams of independent income is increasingly the norm.
The moment you step outside the W-2 structure, you are entering the gig economy. And the regulatory rules here are entirely different, highly complex, and frankly far more dangerous for an uninformed teenager. The safety net of an employer's payroll department vanishes.
You assume total liability. Let's unpack the $400 self-employment tripwire. We're talking about babysitting, mowing lawns, flipping vintage clothes on Depop, or driving for DoorDash.
All of those fall under self-employment. And the massive trap waiting for young entrepreneurs is a specific IRS threshold known as the $400 rule. If your net earnings from self-employment reach $400 or more in a calendar year, you are legally required to file a return, and you are subject to the self-employment tax.
Wait, $400 over a 12-month period is an incredibly low bar. You could easily hit that by mowing 4 lawns a month over the summer. Why is the threshold for gig work so aggressively tiny compared to the $15,000 standard deduction for a regular W-2 job?
The disparity all traces back to FICA. Remember our breakdown of a W-2 paycheck. You pay 7.65%. What you don't see is that your employer is legally required to match that contribution.
Oh, right.
The total true FICA tax rate is actually 15.3%. The critical difference with gig work is that when you are self-employed in the eyes of the IRS, you are both the employee and the employer.
So you're wearing both hats, which means you have to pay both halves of the bill.
Precisely. You are entirely responsible for the full 15.3% self-employment tax. And the federal government is highly aggressive about collecting these funds because they tie directly to the solvency of Social Security and Medicare.
So even if you owe absolutely zero federal income tax because your total earnings are well below the W-2 standard deduction, if $400 of that income came from self-employment, you still owe that 15.3% on the gig income.
That is the exact paradox that traps so many teens.
I look at that threshold like an invisible tripwire in the grass. You think you are flying completely under the radar because $400 feels like informal pocket money. It doesn't feel like a real business. But the moment you cross that line, you trigger the alarm.
And if you don't file, the IRS considers it tax evasion. And their ability to enforce that tripwire has increased exponentially recently. This brings us to another massive shift from the OBBBA, specifically regarding third-party payment apps like Venmo, PayPal, and Cash App.
Historically, there was a massive cultural blind spot here. People treated Venmo transactions like passing a $20 bill across a table in a dark room. They assumed it didn't exist in the taxable world.
The OBBBA permanently destroyed that illusion. The legislation standardized the rules for issuing a tax document called Form 1099-K. These digital platforms are legally mandated to issue a 1099-K to you and send a copy to the IRS if you cross $20,000 in gross payments and conduct over 200 transactions.
Let's aggressively challenge a widespread myth right here, because I see this terrible advice all over social media. The myth is, as long as I keep my Depop sales under the $20,000 threshold, Venmo won't send me a form, so the IRS doesn't know about it, so I don't have to report it.
Listening to that myth is a fast track to an audit and crippling penalties. The reality of the tax code is that you are legally required to report all business income from the very first dollar you earn, regardless of whether a form is generated.
So the threshold is just for the platform.
Exactly. That $20,000 threshold has absolutely nothing to do with your personal tax liability. It is the legal trigger that dictates when a corporation like PayPal is forced to tattle on you, but your legal obligation exists entirely independently.
So if I make $5,000 selling custom art on Venmo, I won't get a form, but if I don't report it, I'm committing tax fraud. It's the exact same logic as a speed limit. Just because the city turned the speed camera off on a specific road doesn't mean the speed limit ceased to exist.
That analogy highlights the risk perfectly. And this is exactly why operational disorganization gets expensive incredibly fast, because when you are in the gig economy, you are not taxed on your gross revenue. You are taxed on your net profit.
Walk us through the mechanics of that. How does a teen mowing lawns legally protect themselves from being crushed by the self-employment tax?
The most critical habit is meticulously tracking your business expenses. As a gig worker, the IRS allows you to deduct ordinary and necessary business expenses on a specific form called Schedule C. Every legitimate expense you claim directly lowers your taxable net profit.
So if I run a lawn care business, I don't just pocket every dollar. I have to buy gas for the mower, pay for blade sharpening, maybe print flyers. Those are deductible.
All of those are deductible. If you babysit, a CPR certification class, or craft supplies, for the kids deductible.
Let's run the math on that. If I collect $500 in cash from mowing lawns, I've crossed the $400 tripwire. But if I kept my receipts and can prove I spent $150 on gas and repairs, I only actually pay taxes on $350.
The mechanism is exactly right. Your gross was $500, deductions were $150, so your net profit is $350. And in that specific scenario, something incredibly beneficial happens. Because your net profit dropped below the $400 threshold, you legally bypass the self-employment tax entirely.
That is a massive paradigm shift. Keeping receipts literally keeps you below the tripwire. But the gig economy of mowing lawns is one level of complexity. What happens when your digital side hustle explodes and you go viral? Because the rules seem to warp entirely when we look at the creator economy.
The creator economy is fascinating because it evolves so rapidly that it outpaced the legal framework. The IRS had to aggressively adapt 20th century tax codes to fit this 21st century reality. When we talk about influencers and the infamous PR gift trap, we have to understand how the IRS classifies making content.
Because a lot of teenagers filming TikToks in their bedrooms assume they are just engaging in a monetized hobby.
The IRS does not view it that way. They have a specific stress test to determine if it's a hobby or a business. If you are regularly uploading, investing in equipment, dedicating consistent hours to editing, and actively seeking sponsorships, the IRS classifies your channel as a sole proprietorship. You are an entrepreneur.
And a creator business is super complex because it relies on multiple fragmented streams of income.
Managing that cash flow is chaotic. You might get AdSense revenue from Google, payouts from the TikTok Creator Fund, affiliate commissions from Amazon, and direct payments from brand deals. If any one of those partners pays you more than $600, they must issue you a Form 1099 NEC. You could end the year with a dozen different tax forms to reconcile.
Managing the cash is hard enough. But the biggest landmine isn't the cash, it's the physical stuff, right? The PR gift trap. You constantly see influencers posting unboxing videos of free cosmetics or tech gear sent by brands.
This specific regulatory mechanism catches almost every young creator off guard. Let's detail the absolute reality of gifted items. If a tech company sends you a brand new $1,000 camera to review, that is not a gift. It is a barter transaction. The fair market value of that camera is considered taxable business income.
The irony of a free PR package is basically tragic. It is the exact same dynamic as winning a car on a daytime game show. You see the contestant crying tears of joy because they won a car, and then the producers explain they have to immediately pay $5,000 in taxes just to drive it off the lot. A free gift is actually just a tax bill wrapped up in a pretty box.
It is a phenomenal analogy. If you accept that $1,000 camera, the IRS treats it exactly as if the company wired you $1,000 in cash and you went and bought the camera yourself. You now owe self-employment tax, and potentially income tax on that value, even though you never received a single dollar bill.
That creates a terrifying cash flow crisis. If a 17-year-old creator is getting paid erratically and suddenly owes taxes on a closet full of tech gear they can't use to pay the IRS, how do they survive that?
They have to adopt a highly disciplined strategy known as estimated taxes. Remember, in the self-employed world, nobody is withholding anything for you. The IRS rule dictates that if you expect to owe more than $1,000 in taxes for the year, you cannot wait until April. You are legally required to make estimated quarterly tax payments.
You have to proactively send the IRS a check 4 times a year. What is the tactical advice for managing that?
The overarching rule of thumb from CPAs is aggressive saving. You must automatically divert 30 to 35% of every single dollar you earn into a completely separate, untouchable savings account designated purely for tax liabilities.
30 to 35%. That is a staggering chunk of revenue. But it makes perfect sense when you add up the self-employment tax and income tax. And this totally explains the burnout epidemic online. Our sources noted that 7 out of 10 creators report that financial management and tax anxiety are the biggest stressors.
It's the psychological collision of the W-2 mindset, crashing into the reality of self-employment. People expect taxes to just magically disappear from their check. When you become a creator, you become fully responsible for managing that disappearance.
All right, so we've covered the W-2 employee, the gig worker, and the influencer. In all of those scenarios, you are trading your time and effort for money. But what happens when you remove the labor entirely? The IRS has a completely different set of tripwires for money that makes it self.
We are pivoting now to the taxation of capital. This brings us into the realm of unearned income, the infamous Kiddie tax, and the strategic loopholes of the family business.
Unearned income sounds like a legal term for theft. Let's clarify what that actually means. It is just investment revenue, correct?
Correct. It is entirely passive. It's the money generated by your existing capital. Interest from a savings account, dividends from stocks, or capital gains when you sell crypto for a profit. It is wealth generated by the movement of money, not by your physical labor.
And because no labor is involved, I assume the filing thresholds are different.
Dramatically lower. Remember the generous $15,000 standard deduction for earned income. For tax years 2025 and 2026, the filing requirement for a dependent with unearned income is triggered at just $1,350.
Wow, that is incredibly low threshold.
If your passive investments generate even $1 above that, you are legally mandated to file a tax return.
That is a trapdoor for anyone dabbling in crypto or stock trading apps. And if they cross that, they run straight into the Kiddie tax, which, I mean, sounds like a fake, patronizing term, but it's very real, isn't it?
Exceptionally real. To understand its aggression, you have to look at the historical loophole it was designed to destroy. Congress created it in 1986. Prior to that, extremely wealthy parents were utilizing a massive tax shelter. They would legally transfer millions of dollars in income-generating assets directly into their young children's names.
Because the toddler didn't have a job, their total income was just the dividends.
Exactly. And those massive dividends were taxed at the child's incredibly low bottom-tier tax rate. The wealthy parents were effectively hiding their wealth behind their toddler's Social Security number, entirely bypassing the high marginal tax brackets they should have been paying.
So Congress slammed the door shut. How does the Kiddie tax actually work mathematically today to punish that behavior?
The IRS implemented a tiered system that aggressively escalates the tax rate. The first tier is the safe zone. The first $1,350 of unearned income is entirely tax-free.
Okay, so a little bit of interest is safe. What happens next?
The second tier introduces a minor penalty. The next $1,350 is taxed at the child's own tax rate, which is usually the lowest bracket, around 10%.
So between $0 and $2,700, you are relatively safe.
But the third tier is where the hammer drops. Any unearned income that exceeds $2,700 in a single year is no longer taxed at the child's rate. It is aggressively taxed at the parent's highest marginal tax rate. That could mean the teenager's crypto gains are suddenly subjected to a tax rate as high as 37%.
Wait, let's play out a realistic scenario here. A 17-year-old takes a few $100s from their summer job, invests in a meme stock, and it rockets to the moon. They sell it and realize a $10,000 capital gain. Are you saying that teen could accidentally trigger a massive tax bill calculated using their parents' high corporate salary tax bracket?
That is the exact nightmare scenario. The teen would have to file Form 1040 and attach a complex supplemental document to calculate this penalty based on their parents' return.
This is the ultimate argument for total financial transparency within a family. You can't just day trade in your bedroom and assume you're operating in a vacuum. Your lucky trade could literally cost your parents thousands of dollars.
Transparency is paramount. But interestingly, while the tax code punishes shifting passive wealth to children, it actively rewards parents who integrate their children into active labor. This introduces the family business strategy, one of the most powerful legal tax loopholes available.
A family business operates as a financial shield. How?
The mechanism is built into the payroll tax laws. If a parent legally owns a sole proprietorship, they are permitted to officially hire their child who is under 18. The tax benefit is staggering. The wages paid to that minor child are entirely 100% exempt from FICA payroll taxes.
No FICA. We just spent the first segment establishing that FICA is the inescapable tax. But if you work for your mom's business, you don't pay it.
You pay zero FICA and zero federal unemployment taxes. The child can earn up to their standard deduction, $16,100, completely tax-free. They keep every penny. Simultaneously, the parents get to deduct that entire salary as a legitimate business expense, directly lowering their own taxable income. It's a dual-sided win.
That is unbelievable for wealth building. But obviously, the IRS isn't stupid. The kid actually has to perform legitimate labor, right? A parent can't just write a check to a toddler for consulting.
No, the IRS audits these heavily. The labor must be legitimate, age-appropriate, and paid at a fair market rate. But a teenager could easily be employed to manage social media, edit videos, or do administrative tasks.
Let's push this into the modern digital era. What if the child isn't just doing data entry? What if the child is the actual product? Think of a massive family vlog channel on YouTube where the whole business relies on filming a child influencer.
That specific scenario represents a rapidly evolving contentious area of labor law regarding digital Coogan laws.
Coogan laws?
It originates from a 1939 California law to protect child actor Jackie Coogan, whose parents squandered his film earnings. Historically, these laws required a percentage of a child actor's earnings to go into a block trust. The law is now aggressively expanding to regulate the digital space.
Because the internet basically turned bedrooms into unregulated film sets.
Exactly. States like California and Illinois have recently passed legislation requiring parents to deposit anywhere from 15 to 65% of a child influencer's gross earnings into a locked trust account if the minor's likeness appears in a certain percentage of the content.
So the state government is stepping in to override the parents and secure the kid's financial future.
The regulatory shift is undeniable. Our sources indicate legislative momentum is building across the country.
Now, throughout this entire discussion, we've used the word dependent a lot. The tax code treats you very differently if you are a dependent. Just to establish absolute clarity, what are the actual legal mechanisms that define a dependent? A teen who makes 10 grand on Venmo can't just declare themselves independent to avoid the kiddie tax, right?
No, you cannot simply declare independence. The IRS has a rigid three-pronged stress test. The first hurdle is age. You generally must be under 19 or under 24 if you are a full-time student. The second is residency. You must have physically lived with your parent for more than half the year.
And the third hurdle is where teenagers get confused because it deals with the flow of money.
Right. The most critical hurdle is financial support. You must not have provided more than half of your own total financial support. This is a comprehensive calculation. Even if you earn $15,000 from a gig job, if your parents are still paying the mortgage, buying the groceries, covering your cell phone and health insurance, they are likely providing more than half your support. You remain legally tethered as a dependent.
Let's step back and survey the massive landscape we've just navigated. We started with the emotional gut punch of a $20 FICA deduction and scaled all the way up to $25,000 tip exemptions, invisible Venmo tripwires, PR gifts, and family businesses.
The modern financial landscape is undeniably a minefield for the unprepared. But conversely, it is a landscape of massive opportunity for those who understand the mechanics. I want to leave the listener with a final thought to deeply consider. We are living through the total, unprecedented digitization of money.
Cash under the table is effectively dead.
It is dead. This means the IRS currently possesses more visibility, more data, and more algorithmic insight into our daily transactions than any government agency in human history. The era of informal side hustles is over. The digital economy demands you become a fully operational financial adult the very moment you download your first payment app.
That reality is terrifying, but it is also incredibly empowering. If you actually learn the rules of the game, you get to keep your money. If you remain willfully ignorant, the system is designed to keep it for you. Understanding gross versus net pay, respecting the $400 self-employment tripwire, and recognizing the absolute necessity of filing a return, these are the literal keys to achieving your financial independence. You have to take control of your finances right now before the IRS does it for you. Thanks for listening to the TeensCore podcast. Remember, small money habits today decide your financial freedom tomorrow. See you next episode.
Goodbye, and stay financially sharp.